Nobody taught you this in school. Not really. You might have had a class called economics. Maybe a teacher handed you a worksheet about supply and demand. Perhaps someone drew a graph on a whiteboard and called it the invisible hand. But nobody sat you down and explained the actual system you were born into, the rules of the game you are already playing, the forces that decide whether your rent goes up next year, whether your job still exists in 5 years, whether the money you saved last decade is worth the same today. That system has a name. It is called finance, and most people go their entire lives interacting with it every single day without ever understanding what it actually is. Here's the uncomfortable part. Your relationship with finance began before you were old enough to understand it. The hospital you were born in probably carried debt. The house or apartment you came home to was likely connected to a mortgage or a lease. The job your parents went to every day existed because someone somewhere decided the expected return on investment was worth the risk of starting or funding that business. You did not choose any of this, but every single one of those decisions shaped the material conditions of your early life. Finance was operating on you long before you ever operated on it. And here's the thing about systems you do not understand. They do not wait for you to catch up. They just keep running. And the people who understand how the system works have a significant and compounding advantage over the people who do not. That gap, that knowledge gap, is one of the most consequential divides in modern society. More consequential in many ways than the income gap itself, because understanding finance is often what determines which side of the income gap you end up on. So what actually is finance? Not the textbook definition, not the Wall Street version designed to sound complicated enough that you feel like you need to pay someone else to handle it for you. The real definition, the one that makes sense. Finance is the management of money across time. That's it. That's the whole thing. Every single concept in finance, every product, every institution, every crisis, every innovation, every scandal traces back to that one idea: money moving through time, between people, between institutions, between generations. Think about it this way. You have money now. You might need money later. Or you have a need now, but the money to pay for it will only arrive later. Finance is the set of tools and systems that bridge those gaps. When you save money in a bank account, you are moving your present money into the future. When you take out a loan, you are borrowing from your future self to pay for something today. When a company issues stock, it is selling pieces of its future value to get cash in the present. When a government sells bonds, it is borrowing from investors today and promising to repay them with interest later. All of it, every transaction, every instrument, every institution is just a different version of the same fundamental act, moving money across time. Now, here's where it gets interesting. The moment you accept that finance is about managing money across time, you realize something important. Time itself has a price. This is called the time value of money, and it's probably the single most important concept in all of finance. More important than stocks, more important than crypto, more important than any specific product or investment you will ever encounter. Here's the core idea. $1 today is worth more than $1 tomorrow. Not because of inflation, though that matters too, but because $1 you have today can be put to work, it can be invested, it can grow. $1 you will receive next year cannot start growing until it arrives. This sounds simple, and it is simple, but the implications are enormous. It means that when someone offers you $1 today or $1 in 10 years, the rational choice is always the $1 today. Not because you're impatient, because time has value, and receiving money later means losing the return you could have earned in the meantime. It means that when you borrow money, you are not just paying back what you borrowed, you are paying for the time value of that money. The interest rate on a loan is essentially the price of accessing future money in the present. The lender is being compensated for giving up the returns they could have earned elsewhere. It means that every financial decision you make, consciously or not, is a decision about time. When to spend, when to save, when to invest, when to borrow. The timing of money is inseparable from the value of money. Now, let us talk about where money actually comes from. Because most people have a fundamentally incorrect mental model of this, and it matters more than you might think. Most people imagine money as a fixed thing, a pool of value that exists in the world and gets redistributed through work and trade. You earn some, you spend some. It moves around, but the total amount is basically what it is. This is wrong. Money in the modern world is created primarily through lending. When a bank makes a loan, it does not take money from one depositor and hand it to the borrower. It creates new money. It adds a number to the borrower's account that did not exist before. The borrower spends that money, the money circulates, and eventually some of it comes back to banks as deposits, which then get lent out again. This process is called fractional reserve banking, or more accurately in the modern system, credit creation. And it means the total amount of money in the economy is not fixed. It expands when lending increases and contracts when loans are repaid faster than new ones are made. This is why credit conditions matter so much. When banks are willing to lend freely, money expands into the economy, activity increases, prices tend to rise. When banks tighten lending, money contracts, activity slows, recessions become possible. The Federal Reserve, the central bank of the United States, does not directly control the money supply in the way most people imagine. What it primarily controls is the cost of money, the interest rates at which banks can borrow from each other, and ultimately the rates at which you and businesses can borrow. By making money cheap or expensive, the Fed influences how much lending happens in the economy at any given time. This is enormously powerful, and it affects everyone, including people who have never borrowed a dollar in their lives. Because the availability and cost of money in the economy shapes prices, employment, investment, and growth in ways that touch every household, whether they participate directly in credit markets or not. Let us talk about risk, because finance without risk is just a savings account, and the entire architecture of the modern financial system is built around one central question: who bears the risk and what are they paid to bear it? Here is the fundamental trade-off at the heart of investing. Risk and return are correlated. The more risk you accept, the more potential return you can expect. The less risk you accept, the less return you will earn. A government bond from a stable country is considered very low risk. The government is very unlikely to default, so the return is very low, maybe 2 or 3%. A startup company is considered very high risk. Most startups fail, so the potential return, if it succeeds, has to be much higher to justify the risk of total loss. Venture capital investors expect to lose on most of their bets and need the winners to return 10 or 20 times their investment to make the overall portfolio worthwhile. Between those extremes lies an entire spectrum of risk and return. Corporate bonds, real estate, public stocks, commodities, derivatives. Each instrument represents a different point on that spectrum, a different answer to the question of how much risk you are willing to carry and what you expect to receive in exchange. The key insight is this: there is no free lunch in finance. If something appears to offer high returns with low risk, one of 3 things is true. You are missing something about the risk, someone else is bearing the risk invisibly, or it's a fraud. This is not cynicism. It's one of the most well-documented principles in all of economics, and understanding it would have saved millions of people from the dot-com bubble, the 2008 housing crisis, and every cryptocurrency mania that followed. Let us zoom out now, because finance does not just operate at the level of individuals, it operates at the level of entire economies, and this is where things get both fascinating and slightly terrifying. Markets are mechanisms for aggregating information. When a stock trades at a certain price, that price represents the collective judgment of millions of buyers and sellers about the future value of that company. When bond yields rise, that represents the collective judgment of the bond market about inflation, risk, and the reliability of whoever issued the bond.
This is the mechanism that, in theory, makes markets efficient. All available information gets priced in quickly as traders act on it. Prices adjust to reflect reality in real time. In practice, it's messier than that. Markets are made of human beings. Human beings have biases, emotions, herd instincts, and limited information. They panic, they become euphoric, they follow trends past the point where the fundamentals justify it. They ignore risks that feel distant or abstract. This is why financial crises happen, not because the math breaks down, but because the humans operating the system behave in ways that the models didn't account for. The 2008 financial crisis was not primarily a math problem, it was a psychology problem. Millions of individual decisions, each reasonable in isolation, that collectively built a system so fragile that a relatively modest decline in housing prices triggered a near collapse of the entire global financial system.
The models said it was safe. The models were built by humans. The humans had blind spots. The blind spots became crises. Here is the part of finance that rarely gets discussed in introductory contexts, but that shapes modern life more than almost anything else: compound interest. You have probably heard of it, but most people do not truly feel the weight of it until it is either working for them in a meaningful way or against them in a painful one. Here is the simple version. When you earn interest on an investment, that interest gets added to your principal. The next period, you earn interest on the original principal plus the interest you already earned. Over time, this creates exponential growth, not linear growth, exponential. $100 growing at 7% per year doubles in approximately 10 years. After 20 years, it is roughly $400. After 40 years, it is over $1,500. You put in 100, time did the rest. This is why starting early matters so much in investing, not because of discipline or virtue, because of mathematics. The person who invests $500 a month starting at 22 and stops at 32 will end up with more money at retirement than the person who invests the same $500 a month starting at 32 and never stops. Because the first decade of compounding, the decade the second person missed, does an enormous amount of work. Compound interest also works in reverse. Credit card debt compounding at 22%. Student loans compounding year after year. Payday loans at rates that would make your eyes water. The same mathematical force that builds wealth quietly over decades can destroy it just as efficiently when it is working against you. Finance does not have opinions about which direction it works, it just runs the numbers. Now let us talk about something that most personal finance content carefully avoids. Finance is not neutral. The rules of the financial system were written by people, specific people at specific moments in history with specific interests and specific blind spots. The tax code that makes certain investments more advantageous than others. The regulatory framework that allows certain financial products and prohibits others. The monetary policy decisions that determine whose assets inflate in value and whose wages stay flat. None of it arrived from nature. All of it was designed, and the design reflects the priorities of the people who designed it. This is not a conspiracy theory, it's history. The carried interest loophole that allows hedge fund managers to pay lower tax rates than their assistants was not an accident. The bankruptcy laws that make it easier to discharge business debts than student loans were not accidental either. The structure of the mortgage interest deduction that primarily benefits homeowners over renters. The capital gains tax rates that tax investment income at lower rates than labor income. Each of these represents a deliberate choice embedded in the system. Understanding finance means understanding not just how the system works, but why it works that way, and recognizing that the rules can be changed, have been changed, will be changed again. The question is always by whom, for whom, and at whose expense. So here's where this leaves you. Finance is not something that happens to sophisticated people in glass towers. It's the water you're swimming in every day. Whether you're paying rent or a mortgage, saving or spending, working for a wage or running a business, buying groceries or investing in a retirement account. The question is not whether finance affects you,
It does, unavoidably, constantly. The question is whether you understand it well enough to navigate it intentionally rather than accidentally. And this is where the knowledge gap becomes personal rather than abstract. The person who understands the time value of money makes different decisions about when to spend and when to save. The person who understands how credit works avoids the products specifically engineered to extract the maximum possible interest from them. The person who understands risk and return is harder to sell on investments that promise high returns with low risk. The person who understands how the rules are written is less surprised when the rules seem to favor certain people over others and more equipped to work within and around them. None of this makes finance fair. It's not particularly fair. None of this means understanding finance guarantees good outcomes. It does not. But it's the difference between navigating with a map and navigating without one. The question worth sitting with is this: if finance is the system that determines how resources move through time, through society, through generations, who gets to accumulate and who stays stretched, whose assets appreciate and whose wages stagnate, why is it the one subject that almost no one receives a meaningful education in before they're old enough to be fully subject to its consequences? The answer to that question tells you a great deal about whose interests the system was designed to serve. And whether or not you find that answer comfortable, you're already in the game. You might as well understand the rules.